Hey everybody, welcome back. Unit 4, the financial sector, banking, and the expansion of the money supply. Subunit 4.4, part 4.2 in this subunit. Still on the money multiplier. If you have watched part 1, part 2, part 3, part 4.1 and are now watching this one, I salute you. Fantastic, okay? This is our last one of this subunit to get the basics. There's actually going to be some more later on to get into this a little bit deeper, but to get the real foundation, this is the last one, okay? So if you made it this far, great job. Let's get to it, okay? This one that I'm doing here, 4.2, is connected to part 3. What happened in part 3? We had the Fed kick off the money expansion process. In other words, we were in a recession. Fed says, hey, I want to increase the money supply. I want to increase the amount of money in the economy. The way that I can do that is I can just create reserves. I can get those reserves into the banking system and hope that those get lent out, creating money, okay? So that's the one we're attached to here. So let's kind of just recap it really quickly, just doing Bank 1's balance sheet, okay? So what the Fed is going to do is what's called an open market purchase. They're going to purchase U.S. government bonds from Bank 1. So Bank 1 bonds, all right, are going to go, once again, these are U.S. Treasury bonds, are going to go down by 1,000. And what the bank is going to get for this asset that they are giving up is they're going to get reserves of $1,000, okay? That transaction right there is T1. That is what the Fed is going to do. That's going to be the interaction between the Fed and Bank 1. After T1, if you watch part 4.1, you know after T1 we can answer our initial question here. Maybe I shouldn't even use the word initial right now. We can answer this question right here, which is immediate change in the money supply, i.e. from the Fed's action, was there an immediate change in the money supply? Did it change from that transaction? Answer, no. How do we know that? I don't see currency in circulation anywhere. I don't see demand deposits anywhere. Currency in circulation did not change immediately. Demand deposits did not change immediately from the Fed's transaction with the bank. So the answer is no. Now, 6 more questions. Max initial change in. Remember, we don't always need the word max. I'll try to say when that's applicable and when it is not. And then max change in. This column right here related to the first bank, okay? This column right here related to the entire banking system. Let me say that again, guys. This column related to the first bank. This column related to the whole banking system. This column is when all the dominoes have fallen down, okay? That's what this one's about. This is more about the first domino, if you will. All right. Don't think about dominoes too much. It's not that important. All right. Let's get into this. To answer these questions, we do want to do T2 also. T2, what's going to happen in T2? It's going to be a loan. How much? Well, I'm going to have the loan be the maximum amount the loan can be. What is the maximum amount the loan can be? Again, I'm going to say the required reserve ratio is 10%. Again, it's a bit of a trick. Do not say the first loan, $900. Why? The first loan can actually be the entire $1,000. This is not important for the first loan in this situation. Why is that, guys? Because Bank 1 got their reserves by selling something they owned. They did not get these reserves by taking on a liability. You see, this comes into play when a bank gets their reserves by taking on a demand deposit, a liability. That's when this comes into play. Since the bank sold an asset, something they owned, then they can loan out that entire amount. So T2 loan is going to be plus $1,000, and that's going to go to somebody, Robert, as far as we're concerned, okay? Now, Robert is now going to get a checking account with $1,000 in it, and guys, that loan changed the money supply, because Robert can now go buy goods and services. Now that we have done T2, T1 and T2, we can answer these 6 questions. If that didn't make complete sense to you, go back again to part 3, okay? But anyhow, let's finish this off. max initial change in demand deposits. That's right, I need the word max. Why? Because the demand deposit was actually created by a loan, and their Bank One did not have to loan out the full amount. They did not have to loan out all of their excess reserves. So the max initial change in demand deposits, what was it? It's right there, guys, $1,000. $1,000. Max initial change in bank lending. Okay, so if you're wondering why I'm saying bank lending, that's bank lending. What I'm basically doing is I got this blank right here, and I'm just putting these three things into the blank one by one. So max initial change in bank lending, $1,000. Okay, there it is. The loan was $1,000. That was my initial or first loan. Max initial change in the money supply. What was my initial or first change in the money supply? It was this demand deposit that was created. So $1,000. Now, what I need to do is I need to multiply each of these by the money multiplier to find my max change in each of these, okay? What's the money multiplier? Money multiplier is 1 over the RRR. Since my RRR is 10%, it's 1 over 0.1, which is 10. So 1,000 times my money multiplier. Okay, again, I am timesing times my multiplier, money multiplier. 1,000 times my money multiplier, I'm going to put 10,000 right here. 1,000, to get this one, max change in bank lending, so bank lending right there, I need to have the max initial change in bank lending, so I'm taking my bank lending times 10 gets me 10,000. For this one right here, I'm going to take my max initial change in the money supply, 1,000, times my money multiplier, 10,000. One last time, why max, or what do we need to happen to get the max? We need every single bank to lend out all of their excess reserves, not hold on to any of their excess reserves. What else do we need? We need everybody who receives a check from somebody. Remember, somebody's getting a loan, they're going to go buy something, they're going to write them a check or give them money in some way. We need that recipient of the money to go to their bank and deposit the full amount. We need no currency drains, i.e. we can't have anybody go to a bank and say, here's a check for 1,000, give me 100 in cash. That would be a currency drain. We need them to say, here's a check for 1,000, put it all in my bank account. If they do that, if we have no currency drains and banks lend out all their excess reserves, we will get the maximum amount. Whew! That was part 4.2. Now, you should at least know the basics or foundations of banking and the expansion of the money supply. Thanks again. We'll see you in the next video.